0.9%. Let's turn our attention to the personal finance segment then. Hemant Rustagi of Wiseinvest Advisors is our expert for the day. Hemant, we've spoken at length about, the discipline of investing even though the markets may be correcting. Today's question is, although of course the screen doesn't tell you that, but what precaution should an investor take when investing in a rising market to avoid that, scenario when, the markets have rallied all the way and then you start buying in at the highs?
Well, I think a rising market generally evokes mixed reaction from investors. On the one hand, you have investors who, invest in the market without a clear time horizon, without a clear goal. And these are investors typically who invest when the markets start rising. And in fact, many of them, enter into the market at the fag end of the rally. So when the market starts correcting, they stop investing fresh money and maybe hold on to the existing investment in the hope that in future when the market goes up, they can recover their losses. On the other hand, you also have investors who, regret not exiting from the market at much higher level. So obviously they wait for the markets to go up again, with quite determined that they are not going to miss out the opportunity next time. So what happens is when the markets start rising again, these investors start exiting from the market at different phases of the rally. So what happens is some of them, either cut down their losses or some recover their losses and some, exit after making some profits. So clearly, depending at what stage of the rally, if the rally continues, they lose out on the market gain. A case in point here is the last 6-7 months, if you really see, every single month the equity funds have been facing net redemption. But the fact is during this 7-month period, the markets have risen by almost 22%. Then you also have investors who do not invest when the markets are going down, expecting the market to go down further. So when there is a U-turn in the market, suddenly they have this left out feeling and they become, quite aggressive investor, and they repeat the same mistake of investing either without a clear goal or without a clear time horizon in mind. So I think it's always important for investors to remember that the right way to invest in all asset classes, including equity, is to follow your asset allocation model and continue the process irrespective of the market condition. Of course, even for a long-term investor, it's very important for him to reduce the exposure to equity when there is a significant tilt in favor of equity due to rising market. But there has to be a strategy. It should not be done in a haphazard manner. And one such strategy is rebalancing the portfolio. Now, rebalancing is a method that allows investors to bring his portfolio back to the original allocation. Now, what it does is that in a rising market, it allows an investor to exit from equity and go into debt. But of course, there have to be certain points that every investor have to remember. One, it should not be done every now and then. It should be done usually once in a year, and it should be done only when there is a significant move, maybe around 10% or so. Only then the rebalancing should be done. And I think another important point I would like to mention here for every equity investor is that they need to realize that volatility is an integral part of equity investing. So everyone who invests in equity has to contend with that. Thankfully, there are strategies like you invest for the long term, invest systematically. You can not only face volatility but also turn it to your advantage. Now, for example, if you see the last 5 years, which has caused a lot of heartburn for investors, the markets are down by 2% from Jan 8 to Jan 13. But all those investors who invested through systematically SIP have made significant return. In fact, some of the examples we can see here, like we have HDFC Equity, which has given 15% return, Canada Robeco Equity Fund has given 15% return, and there are a few other funds, and there are in fact a number of funds that have given a return of ranging between 10 to 20%. So I think it's important for investors not to get carried away when they see a market rising, not to behave irrationally. The important point to remember is don't look at it as a great opportunity to make quick buck, and also don't look at it as a missed opportunity.
Okay,
I think
Hemant,
follow your asset allocation.
Hemant, what is the exact time horizon that an investor in equity funds should look at? There would be a lot of equity investors who entered in January of 2008 and will still be licking their wounds depending on the fund of their choice. So is 5 years a good enough long term? How long is the long term?
Well, I think that's the important point here to remember for every equity investor is that equity is not a one-time activity. It has to be a process. It has to be like, you need to invest in it continuously. Now, what has happened in most of the cases which you just mentioned where investors have invested in 2008 when the markets were still higher from the current levels, and they have not actually followed it up with the subsequent investment. So it is very difficult to say whether it's 3 year or 5 year. The point is, if you follow a goal-based investing, for example, somebody who's investing for a child education or retirement for 15 years, Well, then you know you have a clear time horizon, you can continue investing. The thing you need to do is maybe a couple of years before you complete your time horizon, start exiting from equity so that you can protect all the gains. But the fact is that it is not, equity investing is not one-time activity. It has to be a process. So if you believe in equity, if you begin investing in equity, you need to follow it up over a period of time.
All right, Hemant, thanks so much. But do stay on. We have a few viewer queries as well lined up on the other side, so stay on.
We were speaking with Hemant Rustagi on how investors should approach a rising market and what they should not do rather than even what they should do. To ask some questions on these and other issues, Anurag Arora from Faridabad in the National Capital Region joins us. Go ahead, Anurag. What is your question?
Yeah, good afternoon, ma'am. I just want to know about the gold ETF. Kindly suggest me the best ETF from where I get a good return.
All right. A metal where one thought there isn't much volatility, but there is. Gold ETF, Hemant, what would you advise, Anurag?
Well, I think first of all, I would say that there is definitely a case for keeping gold part of the portfolio because it has a negative correlation with other asset classes, and also it does not carry any credit risk. Of course, there is a risk of volatility that investors have to face, but that can be tackled by investing systematically. Gold ETF definitely is one of the best ways of buying gold, especially when one is investing in gold for investment purpose. Mutual funds offer two varieties here. One is a gold ETF and the second one is a gold savings fund. These are which are typically fund of funds. The gold ETF is suitable for those investors who either have a demat account or do not mind opening a demat account. So if he is willing to open a demat account or he already has one, he should look at gold ETF because it's very, very simple to invest in this, like buying any other shares. They're more tax efficient than physical gold. The gold ETF, most of the gold ETFs, the performance is very similar because they all track the gold price. So there will be hardly a difference of 0.5% or maybe at max 1%. But some of the gold ETFs that he can consider is the Goldman Sachs Gold ETF and SBI Gold ETF, HDFC Gold ETF. These are some of the gold ETF which you can consider for investment purpose.
All right, Anurag, I hope that solves your queries, and those are a few recommendations of gold ETFs as well. Hemant, thanks so much for joining us. We need to slip into a very short break, but up next